Today, we're taking a closer look at Palantir and Supermicro, two stocks currently in the spotlight. Both are receiving a lot of media attention, but which one should be in your portfolio? Let's analyze them and see which one has a more promising future. Let's start with some context. Palantir, currently valued at $94 billion, ranks as the world's 177th most valuable company. Meanwhile, Supermicro sits at $16 billion, making it the 1,138th most valuable company globally. But Palantir is relatively new to the game, having gone public in September 2020 at $10 per share, while Supermicro has been around since 2007, debuting at $8 per share. Despite being the newer player, Palantir has shown incredible growth, riding the AI wave with its specialized software platforms for big data analytics. They can be considered the architects of digital intelligence, helping organizations make sense of massive amounts of data. The Artificial Intelligence Platform, or AIP, has been a game changer, enabling organizations to leverage AI capabilities without extensive technical expertise. This democratization of AI has opened up new markets and revenue streams for Palantir, particularly in the commercial sector. Supermicro, on the other hand, positions itself as a global technology leader in enterprise, cloud, AI, and 5G infrastructure. They're the ones building the physical foundation, the servers, the storage systems, and switches that power our digital world. While both companies play in the tech sector, they're actually quite different beasts. Supermicro provides the hardware muscle, while Palantir brings the software brains. This distinction is crucial for investors to understand, as it affects how each company responds to market conditions and technological shifts. From a business model perspective, Palantir operates on a high-margin software subscription model, while Supermicro relies on hardware sales with typically lower margins but higher volume. This fundamental difference impacts everything from cash flow to scalability. Palantir's model allows for rapid deployment and updates across their client base, while Supermicro must manage complex supply chains and manufacturing processes. Now, let's talk about stock performance, starting with Supermicro. After its IPO in 2007, the stock spent 15 years in consolidation. Now, it's not the first IPO to take its time finding its footing once floating on the stock market, and it certainly won't be the last. If we compare Nvidia, for example, it remained in consolidation for 17 years when it first floated on the stock market. Supermicro eventually broke out in May 2022 and embarked on an epic 2,800% rally, soaring from around $4 to over $120 by March 2024. It even outperformed Nvidia in early 2024, climbing about 350% between January and March. The broader market conditions during this period were crucial. The AI boom sparked ChatGPT's release, created unprecedented demand for high-performance computing infrastructure. Supermicro was perfectly positioned to capitalize on this trend, as their servers were optimized for AI workloads. Their partnership with Nvidia, particularly in supporting the H100 GPU deployments, proved to be a significant catalyst for growth. But here's where the story takes a dark turn. From its all-time high, Supermicro experienced every investor's nightmare, an 80% decline to under $30 per share. Why? Well, it turns out that there were some serious issues behind the scenes. Their auditor, Ernst & Young, resigned, citing governance concerns, and short seller Hindenburg Research dropped a bombshell report alleging accounting irregularities. This wasn't Supermicro's first rodeo with controversy either. They'd previously faced SEC charges and paid a $17.5 million settlement. Meanwhile, Palantir has been writing a very different story. While Supermicro was tumbling 80%, Palantir surged about 600% during the same period. This impressive run was fueled by several factors: their successful AI platform launch, achieving consistent profitability, expanding their commercial customer base, and securing major government contract. The cherry on top, their inclusion in the S&P 500 in September 2024. Palantir's expansion into commercial markets has been particularly noteworthy. Their commercial revenue grew by 70% year over year, demonstrating successful diversification beyond their traditional government contracts. The company's AI initiatives, particularly its AIP platform, have attracted significant attention from enterprise clients looking to implement AI solutions quickly and effectively. However, we must always keep perspective. Palantir is still trading within its consolidation range between its $45 high in 2021 and $6 low in 2022. Unlike Supermicro's 2,800% monster move, Palantir hasn't yet had its major breakout moment. This brings us to a crucial lesson in investing. Timing is everything. Jumping into a stock during consolidation can leave you treading water for months or even years. Just look at Supermicro. It's had a 120% rise between 2014 and 2015, followed by an 80% drop right back to its IPO price, then 3.5 years of consolidation before the breakout and the massive 2,800% uptrend. As already mentioned, this pattern of remaining in long-term consolidation is common for stocks after their IPO and highlights the importance of patience and proper entry points. We've created a blueprint that identifies the best times to buy stocks. Our members use it to make better decisions, consistently earning profits. If you want similar results, we've included a link below this video for you to download our stock market blueprint. You'll quickly notice an improvement in the quality of stocks you choose for your portfolio. Going back to Supermicro and Palantir, the current market environment adds another layer to consider. We're in the midst of an AI-driven bull market with technology stocks leading the charge. This benefits both companies, but in different ways. Palantir benefits from the software and AI services demand, while Supermicro capitalizes on the hardware infrastructure needs. However, this also means both stocks are susceptible to any broader tech sector corrections. So, which stock makes the better investment right now? Well, both come with their challenges, so let's break it down. Supermicro is clearly the riskier play. With their ongoing issues, they're like a falling knife. And you know what they say about catching those. For Supermicro to become interesting again, we need to see price stabilize and form a solid base over several months, followed by a confirmed breakout to the upside, suggesting a recovery back to its all-time high. The weekly 200-day moving average, currently around the $23 mark, could provide a potential support level for this base to form and be the catalyst for the bulls to come in and push the stock price back up. Palantir, on the other hand, looks more promising, having already climbed 600% since 2022 and 160% in 2024 alone. However, there are two key hurdles. First, we need to see a confirmed breakout above the all-time high and also the $50 psychological level. A close above $50 could open the door to $100 in the coming months. Second, Palantir is still unproven in terms of major uptrends. It hasn't had any trading inside that consolidation we've already looked at since its IPO. Between the two, Palantir gets my vote, but only if it can clear that $50 hurdle. It's already moving in the right direction, which is up. Supermicro only seems to be heading down for now. Remember, patience is crucial in investing. Don't jump in too early just because of FOMO. If given time, Palantir could be incredibly rewarding. And let's not completely write off Supermicro. If we look at Meta and Netflix for a second, Meta has climbed 550% after a 70% decline in 2022. Netflix has climbed 360% after a 77% decline in the same time period. This shows us that impressive turnarounds are possible with the right leadership and decisions. Looking ahead into late 2024 and 2025, both companies have potential, but they'll need to navigate their unique challenges. Palantir's AI expansion and consistent profitability look promising, while Supermicro will need to address their internal issues while capitalizing on the growth demand for AI infrastructure. As investors debate which of these two giants will outperform the other, another tech stock seems poised to break out of consolidation. Check out this video to see if Apple can rise to $300 per share.